Welcome to our Merry December regulatory brief, where we will cover the most important regulatory developments for the month of November 2025. I am Stephanie Lyon, and with me today is part of our expert team. We have Alicia Briley, Senior Reg Compliance Counsel, and Tony Fennell, Compliance Risk Expert. As always, we'll start with issues affecting the industry before we narrow in on depository institutions. Let's kick this month off with a self-created crisis. The CFPB has nearly turned itself into a zombie regulator, as it is now claiming it may run out of money to operate as early as December 31st, 2025. This whole saga begins with a self-inflicted funding problem. Earlier this year, Acting Director Vaught declined to draw funds from the Federal Reserve, claiming that the Bureau had adequate resources. Then Congress passed the One Big Beautiful Act, which cut the CFPB's funding cap roughly in half. Now, the CFPB has suddenly declared it cannot legally draw funds after asking the Department of Justice to provide a legal opinion letter. Now enters the funding legal theory. At the heart of the controversy is a fight over two really important words that are in the Dodd-Frank Act. They are combined earnings. The current administration has taken the novel position that the Fed can only fund the Bureau when the Federal Reserve has profits, not gross earnings. Under normal accounting, though, you may remember that earnings is generally considered to be gross, and even the Federal Reserve labels their losses as net earnings rather than just saying earnings. But as the courts have not taken up this funding theory to tell us one way or the other, we don't really have a definitive answer yet. To avoid collapse, the CFPB is proactively transferring all of their active litigation, including their very light enforcement docket, over to the Department of Justice so that they can continue to operate normally there. The funding crisis may soon create a constitutional problem for the executive branch, though, which is tasked with ensuring that the laws are faithfully executed. Remember, many of the CFPB's functions, from supervision, enforcement, rulemaking, are required to be performed as a matter of law. So if the Bureau stops performing those tasks, they may risk violating the Constitution's Take Care clause. This leaves the Bureau in a very sticky situation between we can't operate where we actually legally are required to operate. So two imbalances right there. We don't think that we should be writing the CFPB's eulogy just yet. That cat still has many lives left. So while the Federal Reserve has not been profitable since 2022, some experts are now predicting that the Federal Reserve could go back to positive net income as early as Q1 2026. If that happens, this whole funding problem that the CFPB has may completely implode. But because of the OBBA that we talked about earlier and that funding cap being slashed in half, the CFPB may not be able to continue to fund their staffing levels where they are today nonetheless. So that brings us to a surprise announcement. The CFPB is set to resume examinations after about 10-month hiatus. Yep, you heard me right. Despite warning courts and Congress that it is on the brink of a shutdown, the CFPB has announced that they will resume examinations, and every examiner has to adhere to what they're calling a humility in supervision pledge. It basically means that exams will be shorter, they will have a tighter scope, they will provide that advance notice to institutions so that they know that the examiners are coming. Their findings are going to be focusing on patterns and practice with tangible consumer harm as opposed to that theory of harm. And examiners will attempt to resolve every issue through supervision rather than enforcement. And our institutions are now being encouraged to self-report any issues. What that means for your institution under this new supervision landscape is significant less visibility to what the CFPB is actually prioritizing when it comes to both enforcement and supervision. It also means significant more responsibility on you to find and fix your issues. And self-reporting any issues, that's going to become a critical strategic tool because you may need to balance when to do it, how to do it. In large, complex institutions, you're likely to see the CFPB significantly less going forward. In other words, we do see that the Bureau is shrinking, but obligations to comply with existing laws, rules, regulations, that really hasn't changed. If anything, the burden is shifting to your institution because we're not going to have that type of robust supervision we're used to in the past. And the last line of defense, well, that may just become your risk, compliance, and audit teams at your institution. So make sure you strengthen your programs right now. Alicia, I'm going to hand it over to you to talk about rule changes at the CFPB.
Oh, yeah. And I have a few of them to talk about. It might be slowing down in the future, but right now it's still moving forward with the update. So let's start with some Section 1071 updates. I know that's everyone's favorite thing to hear about as of late. But with that, we're going to talk about a compliance date extension. So you might remember that back in June of this year, the CFPB actually submitted another extension of compliance dates for the 3 tiers. So those staggered deadlines that we've been seeing since the final rule was published and just kind of changed over time. So why the extension? Well, first, litigation created kind of like a patchwork problem. So there were some institutions that had compliance dates, others that were part of the injunction. So it was very messy and confusing. So they wanted to make those dates uniform. And then they also wanted to give themselves more time to reconsider certain provisions based on stakeholder feedback, based on everything going on with the new administration. So there's really been a lot going on. So now those dates are officially extended now that the rule has been finalized for a year past what those tiered compliance dates originally were. And that's both for the compliance date itself on when you have to start the data collection and the rule filing. But here's the little thing that I want to add here as an actual added note, and this is important. So while these compliance dates are now final, they may not matter much longer. And why do I say that? And it's because the CFPB just turned around and proposed sweeping changes to the entire rule that could kind of kick a huge chunk of institutions out of its scope entirely and change how those compliance dates work around. So let's actually talk about that a little bit more, because this is my next update here, and that is the changes to Section 1071. We all know that there's been sweeping litigation, there's been changes back and forth, a lot of sleepless nights. So the Bureau is essentially hitting reset on Section 1071. So now they're saying that the 2023 final rule was too expansive, too many lenders, too many products, too many data points. And this broad coverage approach created unnecessary complexity, undermined data quality, and really disrupted small business lending market based on what institutions were saying that they were going to have to do in order to be able to keep up, because the Section 1071 rule was such a huge undertaking for them. So the new philosophy here is an incremental approach focused on core products, core lenders, and core data points. So the CFPB explicitly compares this to the HMDA's 50-year evolution. So basically starting narrow, expanding gradually as the industry and regulators figure out what actually works, and making changes based on that information. So now, whether you view this as genuine course correction based on industry pain points or regulatory retreat under political pressure probably depends on where you sit. But either way, the practical impact is significant. So let's start with covered financial institutions. So basically who's in and who's out. So first up, the 3-tiered structure, that's going to be gone under the final rule. Under the proposal, there's now going to be a single threshold. So basically, if you have 1,000 covered credit transactions in each of the preceding 2 calendar years, specifically in 2026, 2027, when you're determining whether or not you have to comply with the rule, now there's going to be a single compliance date of January 1st of 2028. So those are two kind of big changes when you think about it from a covered financial institution standpoint. When you're looking at it, you're going from 100 covered credit transactions under what we've known from the 2023 rule all the way up to 1,000 under the proposal. So that's a pretty big jump, which means that's going to make it so a lot of those smaller financial institutions are no longer going to be covered. And the proposal actually breaks that down in more detail to show the difference. And basically, about 2% of the financial institutions that were originally going to be covered under the 2023 rule would still be covered under this new proposal. So that's a pretty big jump. In addition, the proposal also is going to exclude farm credit system lenders entirely. So that is a big agricultural element right now. They're excluding it because of the fact that there is other reporting requirements that would capture this data. Another big one here is the small business definition. So we're going from $5 million as the gross annual revenue down to $1 million, which is what we see under current regulations with the SBA, CRA, and what kind of our business structures are built around right now and what we consider a small business loan. So what they're looking to do is put it down to $1 million to match that industry standard and things that we've seen within other regulations. Now, one other thing to think about and keep on your radar here is if you're also a Community Reinvestment Act reporter or data capturer as well, you want to make sure that you kind of monitor how these two regulations are going to talk to one another in the future. We know that there's been sweeping changes between Section 1071 and CRA modernization. So definitely something to think about, make sure that your small business definition still matches what's expected. Then we also have some transaction exclusions as well. So they added a few extra to that list, starting with small dollar loans under $1,000. So those are out. And this threshold is actually going to be adjusted for inflation about every 5 years, starting in 2035. So really the Bureau's logic with this one is loans this small are typically handled through consumer credit channels or by smaller nonprofits, or smaller institutions that have specialty programs. So they're really not going to give the proper data that's needed for this process. Then agricultural lending, that's also going to be excluded as well as merchant cash advances, which is a big one because those MCAs were a huge topic of conversation during the proposal, the final rule, throughout all the litigation. So they are talking about excluding that. Another big one is data point removals. So we're going to say goodbye to some of these big discretionary data fields. So here's why the Bureau is making its most dramatic cuts. So Section 1071 requires statutory data points, things like application date, credit type, amount applied for, that sort of thing. However, the CFPB was also given authority to add those discretionary data points. They are going to actually now look at removing several of them. And like things like LGBTQI+, that's a big one that's going to be removed. And really that comes on the heels of the presidential executive order that had come out about defending women and directing federal agencies to eliminate references to gender identity and using binary male and female framework for sex and data collection. So that's going to change things around with some of the system things that we've built in place. We're going to probably see changes to the sample data collection form. There's also changes to pricing data, denial reasons. They're seeking comment on some anti-discouragement provisions and some sex and gender components as well. And the anti-discouragement provisions, the low response rates, no response rates, that's a big one there because under the final rule that we knew in 2023, we would have to look at low response rates, no response rates for loan officers, for branches, just to make sure that we can confirm or better judge whether or not applicants are being discouraged from providing their race, ethnicity, or applying for the loan altogether. It's really utilized in fair lending quite frequently. So under the final rule, if the proposal is finalized as it is right now, the low response rate requirement is going to go away. So there's still a lot more to talk about when it comes to 1071, and I'm sure we're going to have more updates in the future once this proposal kind of moves through the process, but the comment period is open. So if you are a 1071 institution under the current rule that we know from 2023, make sure that you read through this proposal. Make sure you read through what the CFPB is looking for, their reasoning, their explanations. They have an unofficial red line document that you can compare to as well. And then that way you can go through and talk with your lending department, your senior managers, your board of directors to be able to go through and submit your comments and questions. Now I have one more update for you, and that is ECOA Reg B. They are actually looking to overhaul that with disparate impact, discouragement, special purpose credit programs. So this is really kind of shifting gears, but still talking about a Reg B facelift. So with that, disparate impact under ECOA, the proposal would remove the effects test language from Regulation B and replace it with a statement that ECOA doesn't authorize disparate impact liability. This comes on the heels of what we've seen with the examiners removing disparate impact after the presidential executive order from the examination manual. So now they're actually looking to remove it from ECOA as well and make everything more streamlined. Discouragement, so kind of narrowing the standard, making sure that we have encouraging statements directed at one audience that are not discouragement to others. So making sure that everything is clear, we're not discouraging prospective applicants as well. And then we've got special purpose credit programs. So major restrictions on for-profit special purpose credit programs. There's a little difference in there when it comes to nonprofits. So this really applies to most institutions when you look at whether or not you've got special purpose credit programs. And this has also been a big focus and where we've seen controversial thought processes around special purpose credit programs throughout the process and how it applies, constitutional, legal aspects, regulatory aspects. So really there's been a lot of clarity that's been trying to become or come from these regulatory components. So this proposal, this change to ECOA is going to help with that and create kind of more of a streamlined and consistent framework. So we have reg analysis documents for these updates in NComply. We'll continue to update and provide necessary updates throughout NComply and our reg briefs. But the bottom line, CFPB is fundamentally reshaping what we've been seeing, but there is still a lot to come and know how we're going to proceed with that based on what Stephanie said from her update on the funding.
That's right. There's still a lot left to unpack, so we're going to switch out from 1071 drama to credit reporting drama and preemption. Remember, preemption simply means which laws reign supreme versus which ones are invalid. Last month, the CFPB issued a new interpretive rule on FCRA preemption, that's the Fair Credit Reporting Act. And they basically just said, look, federal law is the one that's calling the shots on credit reporting, and most state laws that are trying to regulate what goes into a consumer report are going to be preempted. This is in response to the many states who are passing laws prohibiting creditors from including medical debt in these credit reports. That was once a Biden-era CFPB rule that was later eliminated, so the states took it upon themselves to provide those protections. That new interpretive rule we just have is a 180 reversal from the 2022 guidance that was also issued by the CFPB, which said that FCRA preemption was narrow. And it only allowed states to go further, especially on things like medical debt, rather than telling them they couldn't do it. The new guidance is now saying that FCRA's preemption clauses should be read pretty broadly, meaning that if a state tries to regulate what can be on the report, what can be furnished, or other subject matters that Congress has already addressed in the FCRA, that should generally not be allowed. This is interpretive guidance. This is not binding. It is only persuasive. So courts will ultimately have the final say on whether the state laws that we're seeing regarding medical debt and criminal records are or are not preempted under the FCRA's clause and language. State medical debt bans and limits on credit reporting don't automatically just disappear. So what does that mean for your institution? That means it's a really good time to inventory which states that you may be operating in have credit reporting provisions that may affect you. And you should be flagging them for potential changes and definitely for potential litigation, as we definitely expect some of these plaintiffs and defendants to be out there saying that these laws and rules should be preempted. For now, you still should comply with existing laws and regulations on the books, including FCRA and your state laws, until a court steps in and puts some finality behind this. For incompliant customers, we do also have a regulatory analysis document talking about the FCRA's preemption and providing additional guidance that you can use in your change management process. Let's move on to an issue that is affecting many, if not most, financial institutions, and that is cybercrime. Tony, please take it away.
Yeah, so there's a third-party risk story that's really instructive here. A regional bank recently disclosed that one of their vendors experienced a data breach back in mid-August. The vendor is a digital marketing, compliance, and CRM software provider that works with over 700 financial institutions across the country. As we dig in here, I want to be clear about something. This breach happened at the vendor level. The bank's internal systems were not involved. But as we all know, that distinction doesn't really matter to effective customers. So what data are we talking about? Potentially exposed data includes names, addresses, date of birth, social security numbers, tax identification numbers, and financial information. That's about as comprehensive as it gets when it comes to sensitive personal data. Now, here's what's worth paying attention to. This regional bank handled this the way you'd want to see it handled. When they learned about the incident, they stayed on top of it. They received regular updates from their vendor, and they brought in their own cybersecurity experts to independently assess the nature and scope of what happened and whether their customers were impacted. The bank filed the required notice with their state attorney general, began notifying affected individuals, and offered credit monitoring and identity theft protection services. But here's the big picture. This bank won't be the last institution dealing with this. Just last week, a credit union filed its own breach notification related to the same attack. And according to that filing, the vendor paid the ransom. Now, while paying a ransom isn't illegal, financial institutions need to understand the regulatory risk here. OFAC has issued clear guidance that ransom payments can trigger sanction violations. And here's the critical part. OFAC operates on a strict liability standard, meaning you can be held liable even if you didn't know you were paying a sanctioned entity. On top of that, FinCEN requires financial institutions to evaluate whether a suspicious activity report needs to be filed for ransom-related incidents. So if your vendor pays ransom without proper due diligence, the regulatory exposure can flow back to you. And of course, there's no guarantee the attackers won't still share that stolen data on the dark web. And paying a ransom can signal to other bad actors that your organization, or in this case, your vendor, is willing to pay, which can make you a target for future attacks. Given that this vendor serves over 700 financial institutions, we should expect to see more disclosures in the coming weeks. So what's the takeaway here for your institution? This is really a case study in third-party risk management. You can do everything right on your end, but your customers' data is only protected as your vendor system. So take a fresh look at your third-party risk management program. Make sure your contracts spell out that breach notification requirements and timelines, and have your incident response plan ready to go. Because when something like this happens, your institution is still the one your customers are going to call. You want to be out in front of it, not scrambling to catch up. And one more thing I want to stress here. If your compliance team isn't already a close partner with your third-party risk management team, this is exactly why they need to be. When a vendor breach happens, you're dealing with regulatory exposure, not just operational headaches. You want both teams working together. So now let's shift and move on to issues affecting all depositories. So shifting gears to something a little more historic, the US Mint has officially stopped producing pennies. Now, why did this happen? It comes down to economics. Earlier this year, President Trump directed the Treasury Department to halt penny production, and the numbers tell you why. Over the past decade, the cost to produce a single penny has climbed. You're literally spending almost 4 cents to make 1 cent. Now, that doesn't mean pennies are disappearing overnight. There are an estimated 300 billion pennies already in circulation, far more than our commerce actually needs. So here's where it gets real for your operations. The Federal Reserve Fed Cash Services released some FAQs with 2 key messages. First, the Fed will continue fulfilling penny orders as long as the inventory allows, but that's going to vary by location. They're monitoring inventory at their coin terminals on a weekly basis, and when a location runs out, it stops fulfilling orders. Second, the Fed will continue accepting penny deposits through that. That may also vary by location. So what does this look like in practice? If you try to place an order through Fedline Web or Fedline Advantage, and your endpoint is connected to a depleted location, you're going to see an error message in the application. If that happens, the Fed recommends removing pennies from your order and resubmitting. You can also try ordering through a different endpoint you already have access to, or you can explore alternative solutions for acquiring pennies. Same thing on the deposit side. Some locations may continue to accept deposits even after they stop fulfilling orders. Some may stop both at the same time, and it's going to vary. If your endpoint stops accepting penny deposits, you'll need to contact your local cash office to coordinate an alternate location. Now, the Fed's guidance focuses on distribution. They have not issued official rounding guidance. That's going to be up to the institution. And there's no federal rounding rules on the books. The Pricing Rounding Act of 1985 that would have established rounding standards was introduced, but it never passed. So we've been talking about this for over 35 years. That said, the Federal Reserve Bank of Atlanta has researched symmetric rounding as a viable approach. It's the model that Canada adopted in 2012. So let me walk you through some items you should be reviewing. First, you need to decide on your rounding approach for cash transactions. On the branch side, you need to look at your check cashing procedures, your cash vault shipment orders, your cash stored balancing and outage procedures. You'll also want to consider your coin counting machines, as they'll likely need reprogramming. And here's the big one. Talk to your core provider now whether your teller system needs updates that handle rounding. Whether you adopt symmetric rounding, you're always rounding down, or you're taking another approach, that logic needs to be programmed in before you actually run out of pennies at the teller line. On your deposit operation side, think through your reconciliation procedures. How are you going to account for penny differences in your teller cash? You need a clean process for that. And one more proactive step to consider, think about putting a procedure in place now to limit how many pennies any single customer can withdraw in bulk at one time. You don't want to burn through your remaining inventory before you have all your operational ducks in a row.
Thank you, Tony. Who knew that pennies were going to become something to look back upon, right? Let's zoom over to issues affecting our banks. And we do have quite a few trends that are emerging across the prudential banking regulators. We're talking about fewer exams, more targeted exams, and a much bigger expectation that your institution is going to be self-managing itself between supervisory touch points. Let's start with the Federal Reserve. The Fed announced a new set of operating principles aimed at sharpening bank supervision. What that means is that they want examiners to focus on issues pertaining to safety and soundness. We're talking about capital risk, liquidity, concentration risk, and governance. The Fed wants ratings to reflect better actual risks that these institutions are facing, as opposed to some technical missteps that you may have in your exam. And it also wants remediation to move significantly faster with clear expectations. Examiners are currently being retrained, and the Fed is going to be formalizing this in the future guidance. So this is just the beginning. We'll see more from the Fed on this. Moving on to the FDIC, which is also making exam changes. Earlier this month, the FDIC updated its Consumer Compliance Examination Manual and extended exam cycles significantly for the majority of banks. Instead of the old 12 to 36-month cadence, institutions are now going to be placed into one of three cycles based on their asset size, their consumer compliance rating, and their CRA rating. So these things are all going to work together to tell you how often and frequently you will see your examiners. So if you're lucky, you might be placed in the 66 to 78 month cycle, maybe the 54 to the 66 or 24 to 36. That's a major shift. The shorter exam cycles, we're talking everything from 1 month to every 12-month cycle, is still going to be around for those institutions who pose a lot of risk. So anyone who has a rating of 4 or a 5, which means you have some significant issues and deficiencies in your compliance or CRA programs. So if you're getting something like substantial non-compliance, you're likely to be seeing your examiners fairly frequently. For everyone else, the cadence lengthens pretty dramatically. But that doesn't mean the FDIC is just going to see you once every year and then disappear. So for institutions who are on the longer timeline, so the 54 to 66 or 66 to 78, your examiners are going to conduct something called the midpoint risk analysis to determine whether any targeted visitations or limited scope of work is needed to keep the system safe and sound. It's a good guardrail that allows the FDIC to continue to stretch exams, but not continue to just remove visibility from evolving risks. What this all signals, from the Federal Reserve to the FDIC and even the OCC, who previously announced some of the same changes on prior months, this is a coordinated shift towards risk-based supervision. If your governance is strong, your controls are working as intended, your compliance management system is performing, regulators are going to be stepping back, which is great for you because you can focus on other things that are not managing exams. But if your rating slips, or maybe there are emerging risk signals that are showing up at your institution that are not being properly mitigated, let's say delinquencies go up, the timeline is likely going to start tightening. With longer exam gaps between visitations, you are definitely going to be looking to invest in self-identifying issues, self-correcting, documentation, and ensuring that your remediation is adequate to ensure that safe and sound system at the institution. Now we're going to move on to some updates from the OCC. Over to you.
All right, some positive news from the OCC, especially if you're a community bank. They just announced several actions specifically aimed at reducing regulatory burden, and there's some real substance worth understanding. So let's start with BSA AML examinations. The OCC issued what they're calling the Community Bank Minimum BSA AML Examination Procedures, and these will take effect for exams starting February 1st of 2026. Now, here's the context that matters. Since 2005, the FFIEC BSA AML Examination Manual has applied the same minimum examination procedures across all institutions, whether you're a $1 trillion global bank or a $200 million community bank serving a handful of counties. And let's be honest, money laundering and terrorist financing risks vary dramatically based on your size, your products, your geography, and your customer base. Applying the same exam procedures to everyone has been, in the OCC's words, unduly burdensome, both for the examiners and for your institution. So what's changing? The new procedure gives examiners more discretion. They can place reliance on your institution's own independent testing if it's satisfactory, rather than duplicating the work. For areas like training and BSA compliance officer oversight, examiners can carry forward conclusions from your prior exam if there haven't been any significant changes to your risk profile. And here's a practical one. Examiners now can use discretion in determining whether full transaction testing is even necessary or whether appropriate to limit their review to analytical testing or other reviews. That's a real meaningful shift. Now, here's the second piece, and this one's effective immediately. The OCC is discontinuing their MLR, or their money laundering risk system data collection. If you're not familiar with this one, it's the annual data collection that's been required since 2005, where community banks had to categorize their products, services, and customers according to the OCC's framework. And speaking from personal experience, this was a lot of work. The OCC has determined that they can attain the appropriate information on money laundering and terrorist financing risks through other means, including tailored requests during your on-site examination. So that annual data collection requirement is going away. Now, to be clear, you're still expected to understand your money laundering and your terrorist financing risk in your business and comply with the BSA. But you're no longer required to go through that annual exercise, which I know if I was still in a financial institution is so very exciting. And the OCC has signaled that there is more coming our way. So now we're going to turn it over to Alicia for a little bit more OCC news.
Yeah, so I'm changing it up a little bit. I talked heavy on CFPB. Now gonna kind of continue on with this OCC update, again around community of banks. So this is something a little different that we're closing out with, and it's not really a rule, not a proposal, but more of a request for information. So the OCC released this RFI and are asking community banks to kind of sound off about their relationships with core service providers and other essential third-party vendors. So these complaints are real for many of us. I know when I was at institutions, it was definitely something that made me want to pull my hair out. And that's the vendor lock-in that makes switching feel impossible, opaque pricing that balloons after you're committed, core conversions, which I know is a nightmare for many of us. And they can make us really question our life choices. But the RFI kind of zeroes in on a laundry list of pain points. And really, they want to focus on contract negotiations and terms. So are community banks getting steamrolled in negotiations? What terms are non-negotiable and why? So the OCC really wants to know where that imbalance sits. And that kind of leads into fees and billing practices. So your transparency, your structure is clear, disclosures, pricing, all of that sort of stuff, disputes. Do community banks have any leverage to push back? Core conversions is another big one. Anyone who's lived about that knows it's not just expansive, it's really stressful. And so the OCC is asking, what makes conversions so costly and time consuming? What obstacles do banks face, and are there barriers? The RFI also covers other things like data access, oversight burden, innovation challenges, supervisory burdens that specifically whether the OCC's third-party risk management guidance is imposing disproportionate compliance costs on smaller institutions. So they really want to dig in and look at what community banks are facing. Now, I do want to also add here that community banks, yes, this RFI is built around that. The questions are built around it. It's really focused on it from an explanation standpoint, but they did say in their bulletin that it is open to all banks because let's face it, not just community banks feel these pain points. So if you are an OCC bank, and you want to take the time to read through this request for information and you want to go through and provide those responses, it's really going to help provide the OCC with the plethora of data and information to make future improvements. So I will leave it there. That brings me to the end of my update. Thanks.
Thank you, Alicia and Tony, and thank you for joining us this year for our regulatory briefs. This is the last one of the year, and we want to wish you a merry and bright holiday season, as well as a happy new year. As a reminder, your Comply solution will continue to be updated every single day on these industry shifts we talked about, as well as whatever else is coming our way in 2026. On behalf of the team, we will see you back in 2026 to check up on those New Year Eve resolutions.